Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 8th, 2017. In this video, I want to take a look at the broad markets, the U.S. equity markets via the ETFs SPY, the S&P 500 tracking ETF, as well as QQQ, the NASDAQ 100 tracking ETF. Those two together really encompass the broad universe of the most widely held mega cap stocks, large cap stocks, and a good measure of really where the stock market's going. I'll touch on a couple sectors that I'm watching right now. I know there's been a lot of interest in gold and GDX lately. Energy is one that's been on my radar. I haven't posted a lot of updates, but I am following that closely. The energy sector is important overall to the market, especially to the SPY, the S&P 500, as well as the economy to a greater or lesser extent. And I'll touch on the biotechs and maybe the retail sector, and that's it. So we'll try to keep this relatively brief. Since I haven't done a video in a while, let's just bring you up to speed. Starting out with the weekly time frame, if I don't make mention, the time period we're talking that I'll be talking about, you can see up here in the upper left-hand corner next to the ticker symbol. So this is a weekly chart of the SPY spanning 10 years. And the story is simply this. We had an uptrend line off the 2009 lows, March 2009. That's when this bull market kicked off. We are well into the second longest bull market in history. So this bull market is extremely long in the tooth. Now I'll present both sides of the case. As you guys know, I've pointed out for months, if not years, these building divergences, negative divergences. What I'm referring to here is the fact that the stock market is making higher highs while just about every price and momentum indicator and oscillator is failing to do so. In fact, they're making lower highs. That is what we call negative divergence, and that typically warns of an impending trend change. But right now we don't have any sell signals. The trend is clearly bullish. The bullish case that I hear out there for those who think the market's going much higher, especially this year and maybe going forward, is the fact that we had a multi-year, over 2 years sideways consolidation, this period here that I have highlighted, and we've recently broke out. And so there is some validity to that case. Not that is my belief. I still think the risk reward is over the next let's say 6 to 12 months is skewed to the downside, meaning we're more likely to see the next 20% move in the market to the downside than the upside. That's my opinion. Maintained it for a while, and really the market hasn't gone anywhere. So for anybody that's been a very, longer term bullish or bearish for the last 2 or almost 3 years, nobody's been right. The market has really gone sideways. It's up a few percentage points, from where it was all the way back in 2014 at this point. So there it is. So a sideways trading range, which, to get back to my point, does help in a sense to alleviate the, overbought conditions, let prices catch up with valuations. However, with that being said, we are at extreme valuation levels. I've covered that in another post in the last few weeks, mentioning the Shiller P ratio is at levels only seen a few times in history, and each of those periods were followed by bear markets or even market crashes. So we'll see. Maybe this time is different. That's what they say. I'm not a big fan of that whole this time is different thing. But there it is. Divergent high. This is a trend line to watch on the weekly chart, this yellow uptrend line. And again, weekly charts, they don't change very often. That's why I don't update this chart often. But we use, or at least I use, the daily and even the 60-minute charts to try to hone down my entries and exits. Now, we haven't had any trade ideas on the site, either official or even unofficial, on the broad markets for a while now. But I wanted to do this video. It looks like we're getting close to the next pullback. This is a daily chart of the SPY. It's a little bit busy. Here's an uptrend line off the 2016 lows. It was broken. It looked like the real deal. We had very impulsive selling, and then this was the election right here. This was a Trump pump. The election caught the markets off guard. Markets had largely priced in a Hillary win, and there's the Trump pump. The financial stocks, a couple other sectors did really good, and so the rest is history. So what it was is really it foiled that breakdown. Sometimes the technicals do trump. The fundamentals do trump the technicals. And No pun intended there with the Trump the technicals thing, but that's what happened. You can see the reversal back into the wedge. Since then, we broke down below the wedge and have been back testing below. So it appears to me that the trend line that I had in place here, although it was prices regained that level very briefly, fell back down. And if you really zoom in here, you can see that prices have respected that trend line by back testing it from below and failing to get back up. So this is just still one very large wedge. We had a breakdown, snap back into the wedge, broke down again, back testing, and more importantly, what I'm watching right now to really time any entries on the next swing short trade on the markets is this rising wedge here in purple. Now you can see the story is the same. Although the market pushed up to new highs and seems extremely resilient, each of these highs, there were divergences in place, and each divergence did lead to a correction. You can see divergence right here. I put the crosshairs. Look, divergent high, correction. Divergent high here, correction. You can see the divergence right there on these lines. Again, we have another divergent high, and the big story, the big picture is this is just one long divergent high from this point up. Wrong tool, excuse me. From back here, if I click on this one. There we go. From here to here, that is a divergent high, and that divergence is becoming a little more steep here recently. You can see that. And actually on the RSI, we had a little pop higher here, but you can see the negative divergence right here against that wedge. So now let's zoom down to the 60-minute, spending a little too much time on the daily chart. This is what I'm really watching to hone in on the next short entry, as I said, because of all these divergences. Other things that I'm noticing as well, besides just what I'm talking about here on the charts, tell me that tell me to really be on alert. I think the next big move will be to the downside versus the upside. So the story has been on this 60-minute chart, which I like to hone down on my entries and exits on trades. As you can see here, a series of divergent highs. They're all marked here on the PPO, which I'm using on this time frame, the RSI. So we had a divergent high and a correction, divergent high and a correction, divergent high and a correction. See C3, C2, these are corrections. So my point is that divergent highs, not always, but almost always, I would say 80 to 90% of the time or more, when that divergence is confirmed, play out for a correction. Those are pretty good odds. A lot of my trades are based off, calling bottoms and tops by identifying these divergences, which indicate a trend change. Bullish divergence when you're looking for a low or a reversal after a correction. In this case, these are bearish or negative divergences. So we have a S&P just barely eked out a marginal new high recently, put in another divergent high. And so you've had these series of little corrections here within the wedge so far. See one correction there, another correction after divergent high, third correction. Now, this is the same wedge that I was talking about a minute ago on the daily time frame. I had it in purple. And so we just had a divergent high. That divergence is now confirmed. You can see the PPO heading lower. It has put in a lower high. That's what I talk about, a confirmed divergence versus potential. Potential divergence is when the indicators like the PPO or MACD are still moving higher but have yet to cross over, because they could continue higher and take out the previous reaction high. At this point, they've turned down and are pointing lower. That means the momentum has now turned down and is lower. So that is confirmed negative divergence right here. And because we're so close to now towards the apex of the wedge, this is where a wedge will normally break down. Anywhere from here to here, this is your average breakdown area for a bearish rising wedge pattern. So we're in that sweet spot now. And if you look at how tight the wedge is, it tells me that when these divergences play out, as I expect they will, there are, again, no guarantees, that it will not just bring us down to the bottom of the wedge, that's only 1% or so, if that, not even, but more than likely cause a break of this larger bearish rising wedge pattern, which has much more longer lasting, or I should say more bearish implications, because this is a large rising wedge. It's built over going all the way back to December. So this is now a couple months plus in the making. And therefore, my expectation is, there'll be some little blips along the way, but the next correction is likely to occur. But again, it's been a tough market. The trend is up. If you want to wait patiently, as you should, this is your sell signal. A break of down below this trend line, ideally impulsive selling afterwards. Impulsive when you have these large red candlesticks, that's impulsive selling. This is impulsive selling. That big large candlestick there, that was impulsive selling. You can see it right there. That's what you want to see after a breakdown. Maybe we backtest, maybe we don't. And these are the targets, again, as I shared many times. All right, enough spent on that. Let's jump over to the Qs. And I'll do this much faster since the story is very similar. This is a weekly time frame. Again, jumped out to a weekly. I have various trend lines that you can look at here. And they all have, I think they're all valid. There were reactions off those trend lines. This yellow one, which was the primary uptrend line off the 2009 lows. You had a breakdown, very impulsive price action, back test, and a failure. Another correction after that. And since then, prices have worked their way up to make again a marginal new high, relatively speaking, relative to the scope of this whole move. It's might be few percentage points, 8% or so on this one. The Qs are a little stronger than the SPY, but bigger picture of these white lines here. This is a very clean and well-defined bearish rising wedge pattern. By well-defined, I'm talking about the number of reactions off the bottom of that wedge. 1, 2, 3, numerous right here. 4, 5, 6 candlesticks in a row. So that gives this trend line, in my opinion, a lot of validity. It makes it an important trend line. Therefore, you want to watch for a break of this trend line on the Qs. You have potential divergence. You see how we don't have the PPO turning down yet, so watch for the PPO to turn down soon. The RSI, as you can see, is clearly making has negative divergence in place. We're now overbought, and we need to see the RSI turn down as well and not take out these previous highs. That would negate that divergence and really firm up the longer-term bullish case. So there it is from a daily perspective, and now weekly. Now to zoom down to a daily time frame, as I went over with the S&P 500 a minute ago via the SPY, it's very simple. Divergent highs. Each of these divergences are marks. You had a divergent high, big correction. Divergent high, big correction. These are very tradable. By tradable, I mean swing trade. You can put on swing shorts on the Qs, whatever your favorite vehicle is, whether it's shorting QQQ, any of the leveraged ETFs, NQ, the E-minis, but these are trades that were certainly profitable. They were identified ahead of time with divergent highs. In almost all cases, there were trend line breaks or bearish rising wedges. All the trend lines aren't drawn out here. And here we are once again. You can see the PPO, the RSI, making lower highs while prices make a higher high. You have this minor uptrend line. So this is what I'm watching now. We're going to look at this in a second on the 60-minute chart. It'll show us it a little bit more clearly. So this would be our next sell signal, and most likely take us down to this uptrend line, which again is fairly well defined. The most salient feature I see here on the daily time frame are these yellow trend lines, which form a very large bearish rising wedge pattern on the Qs. Let's get rid of all that. And at the very least, if and when this trend line breaks, which I expect, because that is, again, this wedge is about in that sweet spot of where wedges do break down if they are going to break down. So we're there, and what we're looking at is a move down, probably maybe at least a brief reaction on the first tag of that wedge, meaning a bounce or a consolidation. I think that would take us down to this 116 level right here. And remember, this is a very large bearish rising wedge pattern. Technical analysis, at least you'll see different guides on the web, but if you take a measure a distance of the wedge like I did here. Actually, let's do it another way. I'll use this line so I can replicate it. You take the widest part of the wedge, which I've done here. We'll even extend it out here. Let's just take this part here. And you take that level and you add it to the point in which the wedge breaks down. So if the wedge breaks down here, look how perfectly it lines up with this S3, S2 zone, support zone. So what I listed here, this is major S1, major support zone 1. And this is support zone 2, which I label as critical support, because my analysis on the chart going back, not just what you see here, looking at the weekly chart and some other factors. Critical meaning if that level doesn't hold, we could have a waterfall sell-off, and at that point we'll probably most likely we will already be in a bear market if we get there, because that's 25% below current levels right now. So if we happen to get there, that's a critical level. Maybe that ends the next bear market, pull back in the Qs, whatever you want to call it. But again, we'll cross that bridge when we get there. We'll see how the technicals look. Zoom forward to the 60-minute chart. I've been posting this quite a bit recently on the front page. Here you are, series of divergent highs. Same story, divergent high, correction, etc. Wrong tool. I wanted to draw an arrow tool. A lot of divergent highs along the way, but most importantly, forget about what's already happened. We zoom in, and here's that bearish rising wedge I'm talking about, with this white uptrend line up top and the white uptrend line down below. We recently broke below it, but as I pointed out at the time when this breakdown occurred, we had to wait to see a concurrent breakdown on the SPY, which we never got. The SPY held support, and the S&P 500 is probably the single most important index to watch. Qs often, they're the leader. They've led to the upside, but as I always say, if you want to sharply increase the odds of a long or short trade on the broad markets, do not trade the Qs or the SPY or the mid caps or the small caps in a vacuum. Always watch what the other indexes are doing. And this is a great example. You had a breakdown in the SPY, in the Qs, but we did not have a breakdown. In fact, the SPY was right at support at the time. That support held on the SPY, thereby causing a false breakdown. Qs snapped back up, got back above that inside the wedge, broke down since, and have been limping along below it. See, they've been respecting this trend line from below, back testing and starting to roll over. Pretty solid negative divergences in place. Looks like the PPO is starting to turn down. MACD is moving lower. Trend indicators, on the histogram, there's divergence. Trend's still bullish. So really it boils down to, we have a breakdown and back test in the Qs, but we need the SPY to give way. That's what we're looking at. So if you want to know my opinion, this is our next sell signal, or first sell signal in the broad market, a break of this 60-minute rising wedge, which I'll keep you posted on. Okay, all right, enough on the broad markets. I promised you gold and GDX. You know what, let's do that in a different video. That way we'll keep this one relatively short, and I'll do separate videos. So okay, I'll follow up with gold, GDX. I wanted to touch on the energy sector and the biotechs, and I think I can wrap those up in a different video. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.